From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Hello and welcome to the HPS Macrocast. I'm Matt McDonald. I'm partner at Hamilton Place Strategies. For those of you looking to hear the dulcet tones of Tony Fratto, he is in Europe right now, but I'm holding down the fort. And joined, as always, by our good friends John Fagan and Brendan Walsh from Markets Policy Partners. We're going to talk today about where we are in the economy the week that was, look a little bit at the G20 and what's going on with President Trump over there, and touch a little bit on what we saw this week from the people looking to replace President Trump and go to the G20 in the future, the Democrats who had a doubleheader debate of dozens of candidates vying for the top job. You can check out HPS at hamiltonplacestrategies.com. We're on Twitter at HPS Insight. And you can find out more about Markets Policy Partners at marketspolicy.com. Let's get into it and talk about the week that was. So obviously, President Trump is at the G20, the head-to-head with President Xi Jinping of China, the General Secretary of the Communist Party, the President of China, the head of the Military Commission. They can talk about all the titles that I'm sure Donald Trump is envious of with President Xi. But set the stage in terms of where the economy is going into those discussions and where you guys think it looks. We saw some economic data this week, but where are we broadly?
Yeah, so we saw the first quarter GDP revisions, which remained strong, above 3%. And then actually this morning, we got the personal income and spending and also the inflation data. So this was actually a unique set of circumstances that the Fed is kind of dealing with, where both income and spending are incredibly strong. So actually consumption is running at almost a 4% rate, and wages were up about 0.4%. So that side of the economy is doing quite well. But within the same report, we get the inflation data, where core PCE was at a mere 1.6%, below the 2% inflation target for the Fed. So it's a bit of an odd dynamic where you have part of the economy doing well, but the inflation side doing poorly. For the markets, a bit of a Goldilocks where companies are probably still doing quite well because people are buying things, but the low inflation data gives the Fed room to cut if they wanted to, which is fuel to the fire for an equity rally.
Yeah, that low inflation pressure has been really the main justification for the dovish pivot that we've seen, which began really at the end of last year and has has brought rate cuts into focus. Future, we pointed it out last week and in previous weeks, but
what's priced in now, John?
It is 100% priced in for a rate cut in July. That's the next meeting upcoming. And this week we've heard some commentary from the Fed, maybe shortly on the heels of their meeting last Wednesday, which was taken by markets as a pretty dovish tone, signaling upcoming accommodation. But Chair Powell's comments this week were maybe a little less aggressive on the easing side.
Yeah, Kaplan backed him up this morning.
Less sort of a non-committal, conditional posture, which doesn't necessarily match up all that well with these very lofty odds we've seen. Obviously, within that sort of 100% priced in the futures markets, the difference really over the past week has been the extent to which a 50 basis point cut, which is 25 basis points is the typical increment. 50 basis points is an aggressive sort of opening gambit, so to speak, in an easing cycle traditionally. And markets had been priced for almost a 40% chance of that kind of aggressive start to this easing cycle that they're envisioning. But with not just and St. Louis Fed President Bullard, who's quite dovish, he's been one of the leading doves on the committee. He said that he envisioned maybe 50 basis points of cuts by year end. So the market shaved those odds down to 20%, which shows you that the market really isn't necessarily taking the Fed at face value in terms of their statements.
Yeah. So let me ask this, because we have obviously for the G20 discussions around trade will take center stage a little bit. trade, the baby boom retirement, and changing demographics. This is kind of a different environment that the Fed is operating in. How are they thinking about how does the trade discussion enter into their conversations?
I think about this all the time because the Fed has specifically said, if the trade war keeps going on, we'll cut. But if manufacturing growth is going down because of the uncertainty over either your business being affected by the trade, or you're a business that could be affected in the future, so you're just kind of holding steady and not doing anything new. That's an exogenous factor that's created by two sides putting tariffs on each other. And if this war keeps going, I don't understand what being able to borrow slightly lower is going to do to help the economy. That part is always confusing me.
It's a weird moment where I don't know what the playbook is that
Me
they're
either,
looking
yeah.
at. It has this quality of kind of on a bunch of different dimensions. Is that I think about this from, and we'll get to some of the politics on some of the stuff, but I think about this from the political lens. Is that if anything, kind of coming up on 4 years ago when the Republicans were going through their parade of 20-person debates,
Right.
It became clear that the traditional political apparatus was completely unequipped to deal with Trump, now President Trump, and it feels like the monetary policy and like markets apparatus is equally unequipped to really understand what he's about or what he's trying to do.
Yeah. And going back to that point, listening to the Democrat debates, that this trade issue, especially with China, isn't just a Republican Democrat. A lot of the candidates on the Dem side are just as tough and want tariffs on China as Trump is. So that's been a kind of an enlightening.
Yeah, that's right. It's interesting to observe. I mean, the trade apparatus for decades has been set up with some assumption that trade is a hard sell in Congress, but that the executive branch basically sees the benefits and it's set up to have the executive in the promotion position for that. And now that is not the case, it kind of begs the question of, wait, how is all this set up and what are we trying to do here? And I think the Fed is on the taking end of that dynamic on some respects. And to your point, it's not clear entirely how they will or can deal with that dynamic.
Right. That's why low inflation is kind of it's a handy
Good point.
It's a handy hook to hang their policy hats on. And and Brendan alluded to it before, the PCE. There are obviously there are a variety of different measures of inflation, and so just to Brendan knows this space better than I do, but just to kick it over back to him to talk about why is core PCE is considered the Fed's favorite measure of inflation, and it happens to right now be the lowest, right, among CPI.
Yeah, and it always runs slightly, about 0.2% below the CPI. And actually, I think that it's a relatively simple explanation. The housing, which is a weird metric, it's called OER. It's basically the way they measure housing inflation is not how much your house price goes up. It's how much you can theoretically rent your house for. And in the CPI, the core CPI, it's 40% of the measurement. But within the PCE, it's about 15. And it's actually the same number. They just take it from the CPI. So the number is the exact same. It's just less weighted. So the Fed views the weighting, basically, of the PCE as a better indicator of the overall inflation than the CPI.
So so that would insulate the measure against house price increases, but would still have exposure to what the alternative is in terms of the actual rent and what you can do with it.
Right.
Yeah.
And I think one of the other things we've seen, the interesting commentary from Fed speakers this week, we've gotten a lot of focus in previous weeks on overseas growth problems. They're, to some extent, the U.S., the steadiness / robustness of the U.S. economy is something of an inconvenient factor to a Fed that looks like they're headed into a rate cut cycle. And so they've also been focused on weakness overseas, which is unambiguous. The European growth, although they've had some more encouraging data points recently, European growth still looks pretty squishy.
Yeah, especially the manufacturing. Global manufacturing PMIs are at or below 50 universally.
Right. But as you say, the Fed being in a position where they're trying to deal with a binary risk of trade war on or off? Which is it? How do we come out on that? That's certainly something they've said that they're monitoring. It's very challenging to deal with that, certainly from a policy perspective. The robustness of the U.S. economy versus the rest of the world and the low inflation. But they also have and one of the things that Dallas Fed President Kaplan brought up in his remarks this week was he talked about economic excesses and imbalances. It's a pretty loose fiscal environment right now, and certainly the stimulus from the tax cuts is still percolating, and to some extent through the economy. We've had a very long expansion, and this typically goes with rising debt levels. And some of the valuation metrics at various parts of the U.S. financial markets are getting attention. Obviously, the Fed has talked about leveraged loans and some of these other potential flashpoints where sort of illiquidity and maybe pricing excesses make a more dangerous and flammable kind of cocktail.
Yeah, it's a great point. And it kind of goes back to my point where I don't think 3M being able to borrow slightly lower is going to change there. So that 25 basis point cut is really just going to find its way into financial markets, not into the real economy.
We touched a little bit on the global economy and what the Fed's looking at overseas. Why don't we take a break and we'll come back and set the stage for the G20 as President Trump is making the rounds and planning to make the rounds with the big showdown over there. All right, we're back. Let's talk G20. Let's look at what's going on over there. So we talked a little bit previously about President Trump's brand of personal diplomacy. There are some respects in which he's best understood as a television producer, and looking for the moment and how he can kind of craft the story that people are watching.
Not just a producer; he was a star.
Yeah, but he was a star with opinions.
Right.
It always cracks me up when I see him. Like he was commenting during not to get into the debate, but he was commenting on Twitter during the debate. I can't believe the sound went out. I love it. So listen, setting the stage for that, that is not the type of global leader that markets are used to understanding. So what are markets looking for in the discussions at the G20, in the talks with President Trump and President Xi?
I think the expectations right now are relatively modest. There is not any sort of expectation that a deal will be presented, that the two leaders will hammer out really substantive terms and bridge the gap on some of the tech restrictions, Huawei, the outstanding issues regarding structural reform of the Chinese economy. These are like deep and ongoing challenges in the negotiation, which we saw brought about the deadlock that really began in May. And so there's really an expectation of sort of a change, a reset in tone more than anything else. The general commentary we get from the financial community is they expect an upbeat tone, a friendly, and a sense of constructive engagement, and between the leaders, a reboot of talks and negotiations, discussion about trying to find the way forward together, and so on and so forth. But crucially, a tariff truce. President Trump expressly. Yeah. There's been a lot of crosstalk about that in the lead up to this G20, and market participants are looking for the U.S. side to take the threat of 25% tariffs on the remaining 325 or so billion of Chinese imports and put that on the shelf.
Right.
And those are the better tone, tariff truce, continuing negotiations. Those are kind of the big three that they expect.
And I think somewhat simply, they basically view the president is now in election mode, and he has been tweeting a lot about the equity market being at all-time highs.
Yeah.
So if he played hardball and got a little cocky and walked away and totally disappointed the market, the equity market would sell off and he would cut a deal. So I think there's that kind of belief.
It's entertaining to me on some level that we see the president jawboning the Fed.
Yeah.
And if the Fed is following the market and the market is following him, then I gotta say, who's actually in charge on this stuff?
Yeah.
It has this quality of like he's set up this scenario in some respects. If you want to look at the brass tacks electoral of it, he's set up the scenario where he's the one on the brake, and if he wants to just let the brake go and run through the election, it feels like it's kind of his call to make that happen.
Yeah.
It's an odd dynamic.
And the equity markets, the U.S., obviously, we've seen a little bit of caution coming in ahead of a big pivotal meeting like we got on Saturday, and that's not surprising. But we had, since last Thursday, we put in an all-time record high on the S&P 500. Since then, the market sold off for 4 days and for a total of 1.3%. 4-day losing streak of that totaled 1.3% and retraced half of it yesterday. And that's just not that's not the stuff that suggests a really high degree of market concern that this is all going to fall apart and we're going to be going into a fierce trade war against China. I think the commentary among analysts, though, is a lot more circumspect, like looking down the road and thinking about the prospects for an eventual deal. But what we've heard this week highlights a lot of these ongoing gulfs between the two sides. Reports yesterday came out that Xi Jinping was bringing a set of conditions to solve, and all of the conditions were basically like non-starters for the U.S. side. Remove restrictions on Huawei, take away all punitive tariffs, and no further additions to China's previously agreed U.S. goods purchase commitments. Those, aside from the last one, which is maybe a little gentler, the first two are probably non-starters for the U.S. side, and U.S. officials and Larry Kudlow came on to made remarks yesterday to that effect, and it highlights the challenging and arduous road for these negotiations ahead, no matter how happy how much
it's a great point
comes out of
because
Saturday.
Here we focus on Trump and he'll cut the deal, but we're missing 50% of the negotiating.
Yeah, that's exactly right.
Yeah, so that's the part that always confused me, especially after seeing what the Democratic candidates are. Does China look at last night and say, Biden's probably going to win and he'll be more negotiable?
Yeah,
so let's just ride it out for a year and a half.
I've had conversations with China experts on some of this stuff, as opposed to kind of the markets and economics people that I usually talk to.
And that's who you should be talking to.
And part of what they say is that within China is that there's a perception that Xi really miscalculated in terms of Trump and what the expectation was, and kind of the acceleration of China's ascendancy on the world stage. Those are all real debates that are happening within China on the flip side of this stuff. And it's the bias to kind of focus on what we have control over and what we can see most readily is strong. There is a whole nother side to this. And to John's point on this stuff, it feels to me like the Chinese are still finding their way through the negotiations or figuring out who they're dealing with. And so are we. So it has
what effect these tariffs are having on the underlying economy and whether they can ride it out for another year and a half.
Yeah, that's right. So it doesn't. All of those, I would say, on some level, is that Trump's instinct as a producer and toward drama would increase the variability of the outcome.
Yeah.
He would love nothing more than a big victory celebration type of thing. And then on the flip side, in terms of the vibe of the negotiations, it feels like they are still trying to figure out what the table is that they're dealing with.
Because also, if you miscalculate and you have President Warren, you probably have a tougher negotiator than Trump.
Yeah.
Because she doesn't care about the equity market.
So that is a perfect segue. Let's take a break, and we're going to come back and talk about the Democratic debates that were and the candidates who are looking to succeed the president. Okay, we're back. We're going to talk through a little bit of the, we've referenced some of this throughout, but we're going to talk a little bit about the U.S. political process. We are early in the 2020 field, though every time this comes around, it feels like it's earlier and earlier. We had
I know. Jeb Bush was leading at this point 4 years ago.
We have the back-to-backs this week. Mixing it up, I confess, I felt like sometimes the old model of the main stage and the JV table, maybe there was reasons that was the model, but it was interesting to see them all mix it up. So obviously we're super early in the cycle. The candidates are still getting their footing. This was, I think, the first window into who's ready for prime time and what they're talking about. So how do the markets think about the dynamics that this debate and these candidates present? We talked a little bit about in terms of the trade dynamic is as much as the candidates position themselves as oppositional to Trump, there's not as much daylight on that for a lot of these candidates as there could be. So how do the markets think about these guys?
Well, I think, first of all, it was a really good week. If you were trying to, read the tea leaves as to the market reactions for some of these policy proposals that came out during the debates, this was a pretty good week to do it because there just wasn't that much other news. The markets were in a holding pattern ahead of the
controlled experiment.
Right, a G20 Summit. There wasn't that much data. We did have some Fed speak, but for the most part, this was a pretty placid week without a lot on the calendar, and so it gave a little bit more of a controlled experiment, so you could watch some of the reactions. In general, and we've discussed this a lot on this podcast, just writ large, policy is hard for investors very often. Policies are hard for investors to price in appropriately. Even something that's as immediate as trade. We've talked about just how difficult it is for market participants to grapple with the likelihood of certain policies coming to fruition or not. So they've got to handicap the odds on that, and then they have to figure out if it does happen, to what degree is it going to impact my stocks, or how's it going to impact
There's
earnings,
nothing more qualitative than politics. I mean,
right.
It's tough.
And so it doesn't fit neatly into the models, and that leads in some cases, from our experience, to sort of a default wait and see posture. Sure. And we've seen markets be very reactive to policy, where they don't necessarily try to get. It's so hard to get ahead of these things that once it does happen, surely you get a reaction. We've seen that with trade. Watching all through 2018, the market kind of laugh off the trade stuff until they really began to see that second big wave of U.S. tariffs and it coming through in third quarter earnings season, with corporate management talking about the impact that trade issues were having on their bottom line. And then we got a pretty virulent reaction in October, November, December kind of timeframe. Now, it wasn't just trade, but that was a pretty considerable part of the downside catalyst there. And so in general, policy is hard to price in. And certainly when you have policies that are being bandied about on a stage by candidates for an election in November 2020, and the possible implementation of those is so far beyond the investable time horizon, it makes it a very interesting exercise, and certainly gives investors a playbook to what to monitor. But if candidates come out and talking about hitting Wall Street in these debates, it's not going to precipitate selling of J.P. Morgan stock on this morning. But,
so it's interesting. So Hamilton Place this week did an analysis of all the tweets of the 2020 candidates from the beginning of the year to the debates, and kind of framed that up as what are the topics they're talking about. I was surprised that the dominant topic they are talking about is the economy, and we saw this in the debate. It held forth there too. Is that despite what I would say market watchers and people like us think is a robust economy with some nuance, is that their conversation is very much about how the economy is not working for all Americans, and there is obviously there's kind of debates on socialism, democratic socialism within the party. There's also conversations around there's still conversations around corporate greed, profit, this stuff. We see a lot of this.
That's not going away.
And that is not going away. We're seeing a lot of this in the healthcare space. Mm-hmm. I think for markets, it's a double question of kind of you need to discern what the policy conversation is, how much of it is serious, and how much of it voters are going to buy. I mean, one of the things that we see, drilling down on the healthcare piece, one of the things we see is that there was a lot of conversation in debates on, would you force people to give up private insurance? I saw that.
Who said yes and who said no?
That's a big deal. And you add to that is that's clearly one of the places that on the other side the Republicans are saying, look at those guys, they want to take away your insurance. It's funny to
there's already commercials about it.
It's funny to rewind to one of the core messages of the ACA under President Obama was, if you like your insurance, you can keep it, and that is not where the debate is now. How are the markets looking at the healthcare debate, both for pharmaceuticals and talking about pricing in terms of health insurance and talking about there shouldn't be private health insurance at all? How are the markets thinking about these dynamics?
I think the healthcare sector, certainly when you look at the equity markets, the healthcare sector is the exception to the rule, which we discussed earlier, which is market participants generally don't see these policies as so immediate that they can really price them in. The healthcare really has been, if you're looking for an expression of some of these in equity markets, healthcare is where to look. There's a ETF of healthcare. Obviously, there's a lot of dispersion and kind of different business models within that under that rubric. But looking at the performance of the healthcare ETF, it's up 3% and change this year versus almost 17% for the S&P 500. Now, you can't lay that necessarily all at the door of the Democrats.
Sure.
There's certainly, it's on both sides of the aisle. The executive order that we saw earlier this week about medical, that President Trump put forward about medical cost transparency. He's obviously talked a lot about controlling drug prices. And so this is, it's also a sector that, when it comes to trade, we haven't seen a big trade fight in a really long time. And so it's hard for traders to have a mental map for how this can really play out and how they can trade around it. Well, for something like healthcare, we've seen, if you're a specialist in this field, you're an equity analyst in the healthcare field, you are a policy wonk.
Yeah.
By definition, you're so immersed in the policy moves, it's very front and center to your thinking, and you've got some really obviously contemporary examples of how policy shifts can really hit and really change the landscape in terms of who's up, who's down in the health.
That's right. I mean, we just went through the ACA.
Yeah.
I mean, it's funny. It was funny watching the debate because I kept sitting there and like, we just did the did the thing, right? Remember the ACA?
Yeah, it's a big deal.
Yeah, it was kind of a big deal.
Obamacare.
Yeah, vision of Harry Truman. We're here.
Yeah.
Never mind.
No.
Yeah. So it's interesting. I think that's right. I mean, I think that if you are in the healthcare space, either from a sitting inside one of these companies or as an analyst of one of these companies, is that it's fresh.
Yeah, absolutely. So when they announced antitrust investigations into Google, Apple, and Facebook and so forth, those stocks had a pretty chunky one-day reaction, a pretty solid downdraft on those announcements, and then they basically went marching back up to Google, the exception, marching back up to 2019 highs, and so there's a real distinction between the announcement effect and then the process, which will be long drawn out and potentially inconclusive. But with something like healthcare, it's Bernie Sanders, when he did the Fox News town hall, there was a lot of commentary in the markets about, just how, when he got applause from the Fox News town hall audience on Medicare for all.
Wait a minute, what just happened?
The next day, it fed through into stock prices in the healthcare space pretty seriously. And when they went down, it hasn't. That pricing hasn't washed out.
Sometimes I think that there's a divide between what is a distraction effect of policy and regulatory environment and what is a impact effect of policy and regulatory environment. I mean, I think that the tech world is going to be dealing with a lot of scrutiny for a while.
A long time.
I don't know that implies necessarily breakup type of stuff, but I think it implies a lot of distraction from the top on down. And to this extent you have distraction, you are not thinking about the business. You are not thinking about innovation. Those are all problems that companies deal with that are real.
The lawyers basically take over the companies and protect yourself from regulatory.
Yeah.
As a recovering lawyer, I resemble that remark.
Right.
Well, anyway, it'll provide employment for your kin for many years to come. Guys,
and also I think that the Medicare for all debate's not going away either after this election. That's something that's going to stay with us for a while. I don't know when it's going to be concluded, but
well, there's an aspect of the I think, and we talked about this with the ACA, is that there's a I forget what the rule is. It has to do with like mission creep and like the March of Dimes example, right? Of like you achieve your goal and then you're like, wait a minute, okay, I got to find a new goal. And I think the Democrats are experiencing some of that on the healthcare debate. Is that okay? We achieved kind of what we at the time called universal coverage, but if that's solved and people can't vote for us for healthcare reasons,
it's a big
it's
loss.
A big problem. I mean, it's like
it's
like Churchill getting voted out after the war. Thank you very much. Well done.
We'll build a statue.
Guys, thank you for making the time this week. This has been the HPS Macrocast. I'm Matt McDonald. Thank you to John and Brendan from Markets Policy Partners, and we will see you next week.
Thanks for listening to the HPS Macrocast, produced by Hamilton Place Strategies in association with Markets Policy Partners. For more from Hamilton Place Strategies, follow us on Twitter at HPS Insight. For more from Markets Policy Partners, please visit marketspolicy.com.